Okay, look, if you watched my video yesterday on the Federal Reserve, you remember that the worst pivot that we actually got from the minutes was the potential for a wage price spiral. Today's numbers make that potential worse. We're going to have to get rug pulled. Well, folks, I think the genie is out of the bottle and the Federal Reserve is going to have to rug pull us. This is unfortunate news for anybody who owns equities and great news for anybody who's shorting the market. Unfortunately, it seems like most of us are long the market, and this sucks. 10-year Treasury yield skyrocketing to over 4%, and the 6-month Treasury yield now sitting at 4.24%, as CPI inflation misses every single estimate to the upside. Month over month was expected to be 0.2%, we got 0.4. Core month over month was expected to be 0.4, we got 0.6. CPI year over year was expected to go down to 8.1, we got 8.2. And core year over year in the last report was 6.3. We thought it was going to go up to 6.5. It actually went up to 6.6. So literally every single metric was worse. Now, interest rate futures are pricing in that the Fed's terminal Fed funds rate is actually going to move up from 4.6% to about 4.65%, with swaps pricing in a 4.85% ending terminal rate. Personally, I think both of these numbers are wrong. This report today likely solidifies that the Federal Reserve is going to have to push us all the way to a 5% rate. That means we might end up getting a 1% hike from the Fed, sort of a jumbo hike, to bring us from 3.25% at the Fed funds rate to 4.25%. And then we might end up getting a 75 basis point hike in December as we move to 5% for the Fed funds rate. This is pretty devastating because so far there's no sign that inflation is actually going down as we lap higher year-over-year numbers. And this is the scary thing because it means even though we think, oh, once prices go up, they're unlikely to go up again, right? We'll just lap high numbers and inflation will come down naturally because we're comparing to higher numbers, right? Wrong. Every single month now, we are seeing more and more broad-based inflation. New cars are still getting more expensive. Services are still rising at a 9.6% annualized pace. Shelter inflation, like housing and rent, is still rising at a 9.6% annualized pace. This is absolutely terrible. Now, to some degree, this is expected. Shelter, by the way, makes up the largest sort of weight in our CPI measure at about 32.8% on CPI, a little bit less, closer to 25% on PCE. Either way, it's a huge chunk. And when we get this sort of huge chunk of rent inflation, we expect, okay, well, what drives rents going up? Well, in part, higher rates lead to higher mortgage rates, which in the near term lead more people to rent rather than buy, creating less demand for homes to buy, which is great for househack.com, but like terrible for the economy. And as more people rent rather than buying, well, what do you end up with? You end up with more demand for rentals. So you end up getting rents pushing up higher. So this means the Federal Reserve either has to be patient and wait for rent inflation to rotate down. Because of the concept of inertial inflation, we usually get 6 months of rent pushing up, and this is nationwide. You know, I know we could look to certain areas and say, oh, rents in New York are up, but in Phoenix they're down. That's fine. But nationwide, it's rising. And it's bad because it's rising nationally. We expect to see that rise for about 6 months, and then we might start seeing it falling off. Unfortunately, that means all of the estimates and hopes for potentially an end-of-the-year stock market rally or some kind of end to inflation by the end of the year are probably all dashed. We're probably going to be stuck with this terrible, trashy market today again making brand new lows, which we thought last lows were bad. Now we're hitting even newer lows. We're probably going to be stuck with this kind of bleed-out market, unfortunately, until the first part of 2023, when maybe, hopefully, we actually start really lapping the high CPI reads and we actually start seeing lower numbers. But no guarantees because, again, month over month, we're seeing not only a broadening of inflation, but we're seeing inflation rates continue to rise. It blows my mind that after a year of this, we could still have food rising at 0.8%, shelter at 0.8%, and some of the core things like transportation services up 1.5%, while energy costs are going down. What? So transportation's more expensive while energy's going down? It's mind-blowing. Look at the NASDAQ. This is the NASDAQ. I drew this Fibonacci at the beginning of the morning. And unfortunately, while it perfectly aligns, showing what we previously thought was the bottom of the market is actually now just a 38.2 Fibonacci level over here at the end of February and March, we've actually now come plummeting all the way down to about 261. That's before the inflation report. Now we're down nearly another 3%, sitting at about 254 to 255. Pretty devastating. The market is bleeding money, and this wealth effect is likely to eventually affect real estate, where real estate prices come down, and then we do believe that the wealth effect for real estate owners is substantially more impactful than the wealth effect for stocks going down. Unfortunately, stocks just have to go down first to suffer. So, what does this mean? Well, the Fed is likely to have to rug pull us. And even though markets are thinking that we'll get to a terminal rate of around, again, that 4.625 or 4.65 to about 4.85 percentage, I think we're going to end up seeing the odds of that 100 basis point or 1% rate hike on November 2nd explode. Here are what the odds are right now at the time of this recording. At the time of this recording, the odds for a 1% hike are only 6.5%. All of the odds for a 50% hike, which used to sit around 30 to 20%, have been removed. And now we're sitting at either a 100 basis point hike at 6.5% or a 75 BP hike, which is basically guaranteed at this point at 93.5%. And when I say guarantee, I mean that's like the minimum we're going to get. December's meeting has only about a 3.7% chance that we'll actually see an upper end of 5%, but I really expect these numbers to shift over the next few days as markets really digest this inflationary report and realize, crap, this is getting worse, not better. And the only way to make it better is obviously by joining the programs on Building Your Wealth and using that coupon code linked down below that's expiring tomorrow. But beyond that, we're suffering. Now, it's worth noting that Wall Street suits are telling us that this is a terrible message for Democrats with a midterm election coming up. This is the last inflationary report before the midterm elections. There are a lot of statistics. Fortunately, though, if I could give you any hopium, and remember, hope is not an investing strategy, but if I can give you any hopium, it's the following. This right here is a chart of what frequently happens after midterm elections. The gray kind of gives you a bubble of the range of historical outcomes, but generally, after midterm elections, we tend to see stock market returns improve. That's because when you take the average, you see it tends to look like that blue line, where you could get anywhere between a 10-20% rise over the next 9 months thereafter. That would be wonderful. Now, it's also worth noting that medical services and food and shelter, in total, out of the 8.2% headline rise, contributed over half of the rise, 4.2%. That's because food was up 0.8%, shelter was up 0.8%, and medical services were also up 0.8%. Now, this is really bad because, again, inflation is not just restricted to commodities where we blame Russia or the sanctions that are happening. It's not just restricted to shelter, where obviously we have that temporary inertial inflation where we get 6 months of higher shelter reads before we actually start seeing them come down. But it's also broadening to medical services, which sucks because I'm sick and I feel like I might need some of those medical services. And I'll tell you, I can't spend any more money because I got none left. This sucks. So if you're in pain, I'm in pain too. This really sucks. And all I could do is wish you the best out there. I will say, I think a very important thing that all of us could do right now is think to ourselves, what can we do during this terrible time, during this hellish period of markets to make more money? Because that's all we can do, is focus on, all right, we got Black Friday sales, and it's more like a Black Year sale, and it's just going to be cheaper and easier for us to buy stocks, so let's just go out there and make as much money as possible. And when we make that money, throw it into the stocks. It's actually why, sneak preview, the Path to Wealth course is going to have a complete remake, which is really cool because it's going to expand a lot of things that are in it. And I'm going to give you a hint. It's going to turn into an entrepreneurial course. It's, in addition to the path to wealth, like it's going to have both, just more of the old, but also a lot of new content, which I'm really excited about. Of course, everybody who's already bought in will be granted into lifetime access, but I think that's so important in this market because this is the hardest market to like survive as, let's say, a real estate agent, but it's the best time to get started. Absolutely the best time to get started. I know that's crazy to think, but we're going to look back at 2022, maybe even 2023, and go, damn, all I had to do was buy as many stocks as possible or invest in as many businesses as possible, like Alsac, at that bottom of the market, because after that, you know, knock on wood, that set us up for retirement. Who knows? Anyway, fingers crossed. Thanks for watching. Good luck out there. We'll see you soon. Bye.